Hi, Remy. Welcome to Venture with Grace.
Hey Grace, thank you for having me. Excited to
Uh,
be here.
I feel like you're just like killing it with everything. Like, I feel like you're just like one very smart person. So let's start with let's
Thank
talk
you.
about your journey coming into the US and then started your journey in investing. How do you start your journey in investing?
Yeah, happy to share that. So I'm originally Lebanese. I grew up there. I studied to be an engineer, mechanical engineering at the American University of Beirut, and then went to Columbia to do my master's in applied math. While I was at Columbia, I really got introduced to the entrepreneurial world, tech world. That was back in 2008 and 9. And at the same time, the world of VC had a bunch of interesting companies and ideas I wanted to start, tried, failed miserably. And then I said, you know what? I think these venture guys have it figured out. If you're not that good at execution and you can spot good ideas, maybe you should be an investor. So it was a pretty simplistic way of looking at things. And I became quite obsessed and passionate about getting into this industry and kind of worked my way into it slowly. I didn't have the background or the underlying, I think, like technical skills or knowledge. So worked at Accenture for about a year, then joined a small boutique investment bank called Madison Park Group, where I met my co-founder Mir. We partnered 6 months into it, decided to basically work on launching a small fund as an offshoot of the investment bank. And then that was back in 2012. And then based off of that, we just built Blue Cloud. We partnered up with a third partner of ours, Joel Liu, and then started building the fund. It hasn't been a very easy journey, starting this quite young in my career with not a lot of experience, but it's been a very fulfilling and exciting ride. Today, we're investing out of our $350 million fund four. And we're at the tail end of that, and hopefully we'll start investing out of fund five in the second half of this year. So
Amazing. Well, okay, so let's start with I wonder why did you decided to pick the sector as the software sector? Obviously, right now it's a really obvious choice, but I feel like when you started, especially people in New York, I feel like a lot of people are focusing on consumer or like even media in general.
yeah,
I guess how do you pick the sector?
yeah. So that's a good question. There's a lot of choices sometimes that you make. Actually, for the SAF, for the deciding on software was my partner's decision. I think he's been in this industry. Mir has been tracking this industry, investing, being a banker, but at the same time built a successful seed stage fund or early stage fund back in 2000. Performed extremely well for a 2001 fund. So he was a big proponent of like this, transition to cloud
Mm.
and basically SaaS early on. And then so we started spending a lot more time back in the day before we started the fund on, hey, what do we really want to invest in? And we understood that there's like a lot of stability in the concept of recurring revenue. You can analyze it. You can basically understand it. There was very few true SaaS companies back then. Even on the public side, I think there's like a handful. And I think a lot of the questions we used to get was, is SaaS really going to take off? Like, is this, concept of cloud, companies transition to cloud, is it really going to happen at scale? But we believe that, and that's kind of why we invested, I think, in like SaaS or started investing in SaaS. At the same time, there's, when you think of consumer or media, it's a lot more binary, the outcomes. I think for our first fund, we wanted to focus on something that is less binary and a little bit, like have a better risk reward kind of a profile. So we took, for people that are supposed to take risks, we took an approach where we try to minimize the amount of risk, and which is why also we chose growth. So if you think about it, we did not do Series A for small tiny fund. Our first fund was 12 million. We didn't do Series A or seed. We still tried to invest in growth by slotting in $1 million into like interesting deals, because we wanted basically a more steady kind of returns across the board. And we wanted also to show quicker DPI to our investors to be able to raise another fund. So I think a lot of it came from some understanding, some of my partners saying, here's what we're going to do, some of our prior experience. He's been a like software investment banker for a very long time and has been tracking the evolution of the industry. And our other co-founder, Joel, is a software entrepreneur. So he built a SaaS company, a very successful one that he sold. So I think just their background, some of the things that I mentioned, really drove us into this industry. And it's been a pretty exciting and fascinating industry to learn about, like all the evolution we've seen over the past, I think, 12 years since we started Blue Cloud. Has been amazing, going through the cycles of cloud and data, and then more recently, AI. It's been quite exciting. Lots of change, acceleration and change. So yeah, and also like the whole industry has boomed. I remember when we started, there were like a handful of like growth funds. Most of them were like typical growth equity firms. Not that many scaled SaaS companies. Most of the software companies were like growing slowly, profitable. Very different profile than what it is today.
Mm. I wonder, so I feel like when it comes to like growth stage investing, um, how do you like, since like we chat about like, your first fund's like $12 million, and then like you mentioned like you would at least like slide into like $1 million or something into a deal. I wonder what would be the benchmark for you to exam to see if like a company is a good investment. Also, since like as you know, I'm like focusing a lot more in like the earlier stage. I'm like paying a lot of attention to the earlier stage. And let's say if I like, what kind of deal should I pass along to you that you would think
Yeah,
it's
yeah.
like interesting?
So I'll answer like there's two parts of this question. The first part is, what are we looking for, and basically like how do we pick companies? I think this has evolved for us,
Mhm.
from fund one to fund two to three to four and going forward. Initially, if you look at our portfolio, a lot of our companies, when we started investing, were typical mid-market growthy type deals. So larger companies, companies that are growing slower, profitable or break even or losing a little bit of money. And basically we co-invested alongside a lot of the PE funds or typical mid-market growth equity funds. We As we evolved the strategy, we started becoming a lot more aggressive in terms of what we're looking for. I think both companies started growing faster. Number of SaaS companies exploded. Adoption has really increased, so we started seeing faster growth, and then we started focusing and potentially the ability to build multi-billion-dollar companies in multiple verticals. So we shifted slowly our strategy to more of a venture growth approach,
Mm.
which means that when we're looking at investments today, the focus is really on scale. We think about it a little bit differently. We think about it as how big can this company get. For us, it's really important when we're looking at a business to believe that the company that we're going to invest in can build a really scalable, massive business. And ideally, every company we're investing in, we need to see a path to potentially an IPO. So for us, market, is extremely important. Product and product differentiation also very important, and team. I think this is how we think of basically companies. So for us, it's less about what valuation you're coming in at, or structure, etc. And it's more about, hey, if I invest in this company, how big can it get? Can it get to? And our first benchmark is 100 million in ARR. Can we see this company getting to 100 million in ARR and beyond? And there's obviously multiple ways. It's single product, moving to multi-product, mid-market, moving up market. There's like different benchmark along the life cycle of the software company that we're looking at, depending on what stage we're coming in. Typically, I would say most of the companies we're looking at are 10 to 50 million in ARR. We do invest sometimes earlier, sometimes later, but the majority would fall within this bracket. Majority of our companies are growing actually at an accelerated, pace. So let's say 70 plus, 70 to like 200% year over year. And then most of them hopefully will get to basically north of 100 million, et cetera, and on path to IPO. I think we've done quite well. If you look at our portfolio, I think north of 60% of our companies reached the 100 million ARR mark. We have several that are north of 200, some that are north of 500. So we've seen scale. and that's been an exciting journey for us. So again, it's really about product, market, and obviously execution. Where we usually take risk, or we're more comfortable taking risk as a firm, is basically on the execution side. I mean, going from one product to multiple product, moving up market. It's a building a PLG motion if they have to, etc. And as we basically kept building kind of our, I would say, mindset as investors or thesis, you become better and better. As you invest in the same category of like category or class of companies or types of companies, you become better and better at actually quantifying risk and understanding basically risk. And I think as an investor, if you are aware of the risks you're taking and can quantify them, you can actually do well. And the second thing is, if you're very consistent in the way you look at companies and the type of companies you invest in, you technically should do well. We typically underwrite for 3 to 5x, which is not very easy, specifically in this current environment, at a base case, and we need to see a 5x plus. So sometimes, valuations, are a big barrier to entry for us. Especially when you cannot really see or quantify, or whenever you see that there is like enough, let's say, risks involved, where like a large outcome is not necessary, like it's not really, obvious. So that's how we think about it.
Okay, so let's say when you mention like a company that has like 15 to like 10 to 15 million ARR, so I guess like how, like, would you care about like how many customer they have, or should they, let's say if they just land like, I don't know, 5 like big customer with like, I don't know, like $3 million deal or something per year, is that like a better company versus a company that's like getting 100 deal or like 1,000 deals at like a
Yeah,
1,000?
I think we're comfortable with both, as long as you understand, the nature of the business and the type of customers they're selling to. Obviously, you do take customer concentration, you want to take customer concentration risk as basically into account when you're looking at a company. But there are some industries, if you're selling, so we had one company that sold to large manufacturers. They had very choppy, quarterly bookings. So it didn't look like a typical mid-market SaaS company. You see like million, 1.5 million, 2, 2.5, 3, whatever, 4. It was very choppy. Contracts were very large, but it's the nature of the industry. It's like massive replacements, $5 million contracts, and they built a massive business, and it was a multi-billion-dollar exit for us, and it was a very exciting investment and very successful investment. And we've seen basically some other companies that sold to SMBs that also scaled massive businesses and were multi-billion-dollar exits for us. So both work. It's just you have to understand as a company, you have to understand what are you looking at, why is that the case, how do you basically take this into account? Are they efficient at adding these customers, at marketing to these customers? Do they have a moat or a specific something unique about them that they can sustain long term, and is it a strategic and valuable asset? So there's lots of basically other factors, but we're comfortable looking at SMB, mid market, enterprise, mega enterprise. So for us, it's okay. It's just how we look at it, and what we're looking for in each case is a little bit different.
What about like the unit economics? So for example, let's say if I'm like manufacturing an electronic car, and sure, I would be able to getting, I don't know, like 15 million ARR at a certain stage. What exactly should be my unit economic look like to make sense for like my investors?
Yeah, so there's lots of different metrics that you want to look at, or that we look at usually. I think when we're looking at companies at our stage, it's really about few things. But if you think about growth, it's really about like how effective and efficient are they growing. So you want to look at sales efficiency, ability to keep scaling. You want to look at net dollar retention. They're, I believe, both growth and net dollar retention. So you want to make sure that they're not losing a ton of their customers. Maybe that the model is, onboard, lose, churn, but then the ones that keep there, like you look at cohorts analysis, actually scale with the business. So it depends, but you want to look at gross dollar retention and both net dollar retention. And then there's, other metrics you want to focus on. But at the growth stage, usually if the market is large, if the product is solid, and if the team is good, your company should be scaling really quickly. If it's not, it means one of your assumptions is off. And then you start looking into the product. Obviously, the past few years, I think like 2020, 2021, there was a lot less focus on unit economics, and correlating that to valuation and risk. I think in post the pandemic, we've seen investors going back to focusing a lot more on gross margins, margin expansion, sales efficiency. Like few folks want to look at rule of 40, people want to look at profitability versus not profitability. So everyone has his own perspective, but there's a lot more focus in general on, which is good because that's what you should do as an investor, on basically unit economics across the business. And then there's many things you can look at from an efficiency perspective, but yes, like high level, I would say the few key ones are going to be around that.
I wonder when you talk about when you're thinking about like the different type of SaaS businesses. So I wonder, is there any particular focus that you have that are like, I guess, like being undervalued by like other investor? Because I feel like SaaS is kind of like a table stake, or like enterprise in general. Enterprise software is like very popular in the Bay Area right now, and I feel like it's literally everybody's focus. What would you say would be something that you particularly think it's interesting that most people may not be like interested?
Yeah, so that's an interesting question. To make money in this industry, you have to be contrarian and you have to be right. And that's a very difficult thing. It's a very difficult thing to do. Like everyone has to say no, kind of. It doesn't always be like this. So you get a good deal technically, and the company does extremely well, so it scales. So your returns actually make sense. We'll talk a little bit more about like the different types of funds, I assume, at some point, and how they view the world. But for a venture growth fund, for us, we like our return distribution is we do have outliers in our portfolio, even for a growth fund that will return 1x the fund or more. And you get a couple of those, the rest basically does really well. And you have few companies that return, 1 to 3x, hopefully a good chunk that returns 3 to 5x. And then you have some that will return 5 to 15, 20x in some cases. And then hopefully you don't have many losses, or a few. Now, when you want to get to a portfolio or like a return like that, you have to be disciplined about what you're investing in. And because if not, like your returns, or depending how you're looking at it, if you're consistent at looking at things in a specific way, your returns are going to be fine. But if you're not, it's going to be difficult to generate return on a fund level. So your question about what we're looking for that others are not comfortable with, there's many things. For us, coming in at the right time is usually important. And we do try to come in at an inflection point if possible. It's not easy because it is, a combination of timing, timing it really well so that the company is like few quarters away from becoming like amazing. So it's not easy. Some of the things that we were more comfortable with that others were not were, for instance, channel sales strategy. I think we have few companies, that have a channel sales strategy that I do believe, many investors overlooked because they're not comfortable. It's not your typical, SDR, AEs, kind of model. We were usually a little bit more comfortable with companies that had, I would say, we're transitioning from SMB to mid-market / enterprise. And seeing some early traction of this and understanding how they're getting to it. I think Other funds would say, hey, we'd like to wait. In our case, we would do the work, understand what's really going on. Even if we had like 2-3 quarters of data, we didn't need like a year and a half, and underwrite it. So there's few things, if you start thinking about it, where yes, if you want everything to be perfect in a company, you're going to have to pay, extremely high multiples. Even in today's world, and it's always been the case. If you know how to, again, that's coming back to like underwriting risk and understanding kind of, hey, if this works out, you end up with a massive outcome. If it doesn't, you still end up with a pretty good outcome. It's kind of where how I like to think about it, and basically the stage at which I'd like to come in. But not all the companies have to be this way. And then there are some companies where sometimes valuation was an issue for others, and it was not for us. I mean, rarely, but there are a couple of examples of those where we're still going to do extremely well, because just the sheer size of the market, whatever we were comfortable with. There are some industries that we know really well, like engineering software. We've done very well there. We know it. It's one of these industries where bookings are lumpy. You have to know who the buyers are. There are not that many. But if you know what's unique about the company, if you know how the company can scale, if you're comfortable with that, it doesn't look like a typical SaaS company, you can do very, very well. And we've done very well in this industry. So yeah, it's a combination of things. We typically try to avoid, there's things that we avoid, super crowded industries we avoid. Things that there's some industries that we don't understand, or that received a ton of funding, where you might have one or two outliers. But for us, it's just more difficult, to bet on which one of those is going to be basically the outlier. We invested early on in open source. I think not too many investors were quite comfortable. I think since 2013, we started investing in open source, and we invested in some incredible companies, NGINX, CloudBees, etc. And we did invest in those quite early. So along the way, there are things that we're comfortable doing that we understand well, and others that we're not, I think, as any other VC firm, depending on kind of what the partners want to do, and then what they like to focus on. And at the same time, for us, it's extremely important to partner up with folks that we like and feel comfortable with. We have never done an investment in a company where we did not genuinely feel that, hey, we want to go work for these guys, or we're really excited about what these guys are doing, and we like these people. And in terms of like genuine, good, honest, straightforward folks. So yeah.
I wonder, let's say, if right now, I guess, what does your deal sourcing overall strategy look like? Is that from like, would you go like take the more proactive approach, as like you chase down XYZ because you saw them somewhere, or like would you, or like you have like, I don't know, internal tracker on like a certain things on, I don't know, the characteristics, or would it be like shared by other investor, or shared by people who you're gonna pass the deal along to down the line?
Yeah.
What does I guess thinking framework look like for?
Yeah. So I think this is an industry where if you stop hustling, you lose. I think even the best funds are
Agreed.
constantly hustling. I think there is this kind of mindset that you have to be there, you have to be first, you have to track, you have to stay on top. We did develop internally, over the years, a very, I would say, efficient and effective, tracking strategy, where we do start tracking companies quite early, qualify them early, track them over their life cycle, try to meet with them, build a relationship. It's not easy to do it at scale with a smaller team like us, but we're quite effective and efficient because we're very focused. At the same time, we do complement this with typical outbound, but it's relatively targeted as well. And so we do spend time figuring out, like, it's not like, you put basically like a bunch of names and emails, addresses, and just send automated messages. So we do spend time, on companies, understanding, hey, what's really exciting. Let's just try to get in front of them, etc. It's also complemented by, we've built a good network. I think what I installed on the team when I started, a lot of the deals came from our network, and it still does to a certain extent. So we do collect a lot of knowledge about what's going on, and either get intros to companies from like the Series A funds that we work with, or basically get knowledge, like get insights as to like what's going on and reach out to companies and meet with them. Like, hey, this company is gonna probably fundraise in the next couple of quarters. Great, we'll just go and meet with them if we have not yet. And I think last is we do have most of our, like a lot of our money comes from software CEOs and entrepreneurs, and then we do get deal flow from them as well. So hey, I invested in this company, I really like the founders. They're basically going to raise a growth round, or hey, I just invested in their Series A. Maybe you guys want to look at the B or the C when the time is right, etc. So it's a combination of ways, and it did evolve. I think initially when we started, it was just me and my partner, so the fund was tiny. We had to do everything from LP relationships to putting the memos together to sending quarterly LP updates to doing the accounting and distributions and calling the capital and going to the bank, actually doing wires one by one. So it was very time consuming. So we focused on the most effective strategy, which is partner up with like specific funds and basically work with them. And this worked well for a long time. I think in 2020, and I think we did do obviously like a good amount of outbound and then other things. But I think in 2021 we had to rethink 2020, like kind of our whole approach, because everyone wanted to invest in everything. So we did build basically throughout this period like a different muscle which complements this, which is very good, which is like how you track, how you build, how you look at companies throughout basically their life cycle. So it is a combination, but at the end of the day, it's really about getting in front of a company is obviously it's not the most important thing. It's really making sure that they want to work with you and you want to work with them. So plenty of folks are talking to companies. It's just you want the entrepreneur to feel comfortable and say, you know what, I really want to work with the folks at Blue Cloud, and here's why. And then I have to thank a lot of our, some of them are listening, are entrepreneurs and the like CEOs of companies you've invested in, because they've been the biggest, proponent and I'm not going to say cheerleaders, but of Blue Cloud and the work we've done with them, and they help us a lot in situations like that. So pretty well connected. Some of them had big exits, and whenever we call on them or ping them, they're very happy to like step in and say, hey, would love to tell you about why you should work with Blue Cloud, or why you should work with Rami or Mir, or etc. So that's always useful and helpful. At the end of the day, it is a relationships business, and you want to make sure that you're doing the right thing. And I think we've set very clear guidelines as to how we invest, how we think through investments very early. Since we started, my partner and I started thinking about that and put these guidelines very early, and we abided by them throughout. We've always supported companies who've always been there. We're sometimes, even as a smaller fund, we were the last man standing next to them. When things didn't go well, we helped as much as possible. We basically have always been very disciplined about doing what's best for the company and not what's best for the fund. And that's actually a very difficult thing for a fund like us, who we had to show liquidity, we had to show sometimes exits, and we were always pushing for whatever was best for the company. And this guided always kind of our decision process, which is not an easy thing to do as you're scaling. But yeah.
I wonder when you are thinking about in terms of like the survive to like die ratio in a growth stage, like what does that generally look like? We don't have to talk about your fund. We're just talking about like the general.
So if you think, and again, please don't quote me on that. I think our CFO, Mark, has all this data, and my partner, probably Mir, knows more about it. But I think it's about 13% loss ratio. It's like how many dollars did you invest and did you lose? I think for us, it's, I look, it's going to sound counterintuitive, but the more, like, if you want to take risks, you're going to basically sometimes, like, if you're going to take risks, you're going to lose sometime. And that's fine. That's okay. We've been very fortunate to have taken risks, did very well across all our funds, and at the same time had a very low loss ratio. I think we lost money on one deal in Fund 1 out of 11. We didn't lose all the money, but we lost some money there. Fund 2, we lost a little bit more. Fund 3, we lost a little bit of money, on one deal, and everything else we never lost money. Actually, made money on every single investment, and we'll be making money on every single. Hopefully, let's touch wood. Who knows?
Mhm.
Like it's still not fully. Basically, we fully exited our first fund, except one investment that's still doing very well. Fund two's kind of the same. We still have a couple of companies. Fund three still has a good amount of companies. Unfortunately, we had about 6 on track to IPO. Only one did. So back in 2021, and most of these companies are still on track to IPO. It's just like I think the timeline has been delayed. So we'll see. And Fund 4 is still quite early, but we don't expect to be losing capital. I think when you come into companies at a specific stage, and then if you're looking at things, you can never know, but you can try to minimize this risk. But for me, when I think about it, I don't think it's a massive issue. I mean, what I want to understand is not, hey, did I lose money on a deal or two, but basically, if you're batting for, basically, if you're shooting for the stars every time you're investing, and if it doesn't work a couple of times, that's okay, as long as 80% of the time it is working, and then 30% of the time it's working extremely well, then you're good.
I wonder when it comes to, like, you also mentioned, like, you guys would work with earlier stage, let's say the Series A investors. I guess, like, how do you pick who to work with? Do you feel like it's a numbers game approach, or do you feel like it's a concentrated, like, oh, we're only focusing like 3 funds?
Yeah, I think it's, for us, it was more of a, it was more of, I'm not going to say random because it's not the right word, iterative approach. So what happens is, in this business, unfortunately, no one makes a decision on their own. It's like it's not PE. So you don't own 80% of a company. You own 5 to 20% usually, or sometimes less, sometimes more. But I'm not sure what funds own usually. But that would be, and usually have different stakeholders around the table. You want to make sure, the same way you're working with an entrepreneur, you want to make sure you're working with folks that are going to be aligned with you. Because the journey on its own as an entrepreneur is already very difficult, and building a company is extremely delicate and difficult as well. There's so many factors, macro changes, product issues, personnel issues, hiring the right folks, right folks at some stage are not the right folks at another stage, replacing them at the right time, building additional product, focusing on different metrics of the business, preparing to go public. There's so many things. Raising capital, raising debt, like what's the best thing to do, planning for an exit, yes or no, doing there's so many things. You want to make sure that people around the table have the same mindset as you. And I think it's summarized for us in a few ways. Number one is, you want to have people that are going to be available, helpful, and just genuinely easy to work with. Number two, you want to have people that are going to do what's best for the company as well. We've been into many situations where you see folks trying to push for what's best for them, and either as a partner or as a fund, and it becomes difficult. So what we've done is, and there's other issues that come up, obviously. So what we've done is, as we worked with many funds, because on cap tables sometimes you have like 15, 20 funds. So you get to know a lot of different people. Sometimes it's 4 funds. So you get to know many different people. You start converging and working consistently with some firms, and you become more comfortable with some people. And it's the same things for people that follow us. There are a few firms that work very closely with us and will typically get early access and lead some of our deals. And it's the same thing with the Series A guys, or B guys, where they say, hey, we really like Blue Cloud, would love to have them in our deals. And then we just work closely with them. So we get early access to their portfolio. There's many, many reasons why someone will work with us as a fund. And then so we build these relationships over time, and you strengthen them over time, and become like close to these people. It becomes more of like I'm gonna say extended family, like friends, family, like, and it's nice because at the end of the day, you feel like you're at like war together, you're fixing issues together, you're aligned. It's not like you have to fight five different people, and you feel like I don't really understand why are folks saying that, or like what's their angle, or etc. So it just feels like it's much easier when everyone's aligned usually. And I'm not saying you're always going to see eye to eye, but there's simple ways to resolve things, and basically you just can get to like whatever, like resolutions, and it's easier to work with. So yes, we started with many funds. I think we started basically trickling to like feeling comfortable with like few, worked more with them, but it doesn't mean we will not work with firms that we've never worked with before, or basically like so that's not how it works. You just but in general, if you feel comfortable you're with specific people, you're going to end up working with them.
I wonder, so let's say if someone who is on like a more earlier stage trying to build like a relationship with you guys, I guess like how would you evaluate if they have a good like set of companies that you will be potentially interested in down the line? And I feel like earlier stage, a lot of it were based on like it's a index kind of game, as like earlier stage is a lot easier. Like you said, you want to meet them when they hit the inflection point, but number one, how can you define the inflection point? So is that just like they find product market fit, and or like how do you judge that? And then before, like if people are on the earlier stage, I feel like a lot of the like when I chat with like some LPs, some people want to see like, oh, if the deals are going to be invested by name fund or something. I guess like what would be a good benchmark for you guys to look at? And are the name fund deals, since I feel like we just talked about the contrarian approach, not if a deal is like very oversubscribed by like very great like brands funds, and like I wonder, would that be like a benchmark that you see as like a good or bad benchmark for a company?
Yeah,
Obviously,
yeah.
everything is case by case, but like
Yeah,
in
so
general.
many questions here. So first question was around, hey, how do we decide who to build relationships with in a portfolio? I think we don't have a specific approach. I think it's more of like, you're in this industry, you want to meet as many people as possible. You get along with some people. It's similar to like when you go to university. I don't know if it's a good example, but you're going to become friends with like some people. You're going to become closer friends with others over time, and some people you're going to meet and you're going to go, hey, you know what? Like you're going to be like cordial with, and maybe there's few that you're not going to be super friends with because whatever. So I think it's kind of the same approach. For a long time, we're quite comfortable. We had like few select relationships. I think we've done a big effort, I think, as a firm, to look, when you're building a venture firm from scratch, you cannot do everything at the same time. This is something I had to learn early on. I was very frustrated as a founder. Like, I'm calling myself a founder, but as a VC, like a VC founder, not really a founder, but as a
A
VC
founder
founder.
of a venture firm.
Yeah, because I always wanted to do everything at the same time. And my partner Mira was like, Rami, just we're doing fine. Just we have to slow down a little bit. Like it's okay. There's only so many hours a day. Um, so you learn to take a more progressive approach over time, and then build things step by step. So early on, we built good relationship with like some brand name funds, some smaller funds, and we've worked with all sorts of funds. I think over time we started becoming basically wanting to like increase our reach. It was a little bit annoying when you have 20-30 funds, that like Series A funds, that know you really well, but then like whenever there was like a fund that doesn't know you, they're like, hey, we're not even sure who these guys are. So we've started noticing a little bit more of that, and started leveraging our relationship like with some of these other, like the earlier stage funds, say like, who should we get to know, and start building our network basically step by step. So you'll go to like a fund, say, hey, like who do you really like? Who do you want to introduce me to? Who is like another like Series A or seed or Series B firm that you really like? And they'll say, well, there's these guys, there's these 3 or 4 guys that you should get to know. And they made an intro. We met, build a relationship, looked at some companies, et cetera, et cetera. And it's something again that becomes a little bit symbiotic. So I don't think we had a specific approach where we looked at, hey, let's look at the portfolio. Which companies basically, like, do they have interesting companies? No, let's not like BEng them. No. And especially when it's early, you cannot tell. I think, like there's, you never know. Has never been our approach. The second thing in terms of like, brand firms versus not. For instance, we're a firm that has never really invested in brand. We've always been weak on that front. I mean, when I talk about brand, I mean like general brand, because, both my partner and I are very active on LinkedIn. I'm not even sure Amir has seen what Instagram looks like. I don't have an Instagram. We were talking about that earlier. We don't have Facebook, so we're not very vocal, social people. Like we're not on Twitter. So every person builds its brand, even a different firm, in different funds differently. We also have not really invested in kind of like building BCV's name per se. Just I would say in general, but within basically the firms that know us, I think, like we are quite well known, or basically I think within the kind of community or funds that we work with, and basically people appreciate working with us, and we do appreciate working with those folks. I think building this and I think returns eventually over time are going to talk to themselves. Like if we consistently generate 5x plus on our funds, I think, LPs, basically like other funds, they're going to start seeing some stuff, and once we are going to have a lot of our companies going public, hopefully in the next couple of years, you start seeing a little bit more, basically notoriety, whatever you call it, and like you're so at the end of the day, yes, you can be, if you're a big entrepreneur and join a VC fund, you're going to have already a pre-existing network, and you're going to have like some brand around you. If you join a pre-existing fund that has been around like Sequoia since like, like Confident, like started Sequoia, like one of the 3, 4 people that started VC funds back in the 70s, like, yes, and you've done well, Kleiner, like, yeah, these are funds that have been around forever. And then, so obviously you're going to basically have, a good, or like I would say a more generalized or known brand. But for us, in terms of getting access to deals, what matters for us, and if we want to get access to deals, if we basically want to work with firms, this has never been an issue. Yes, it would be nice if you basically connect with an entrepreneur and say, oh, I know you guys, Blue Cloud has been around. So sometimes you have to go through your network. So again, hey, folks that you've worked with that will recommend you. You have to work with the Series A folks or Series B folks or people that invested before us that will recommend you. Sometimes even growth funds that we love and work after us will bring us into some deals. But yes, so the brand itself, I think, helps for sure upon the first approach, but it's not basically everything, and it's not what prohibits you to get into good companies. And so and in terms of basically access, yes, you will have, it is, you most of the brand funds will have like probably more, like a bigger number of companies, but at the same time, like interesting companies, but at the same time, they're much larger. They invest in many more deals. So you'll see more of that. So yeah. So that's basically to answer some of these questions. And then I think you had one more question, which was around what was your last question? I think there was one more question in what you've asked me.
I feel like you answered them, but like I wanted to know more about like, so let's talk about like, I would say can we chat about like any of your most recent investment that you feel like can you walk us through like how you recognize them, and how do you kind of like approach to win the deal, or like does it even need to win the deal, since like if you're looking at like the undervalued market, and like how do you like eventually thinking about the exit of the company?
Yeah.
Yeah.
You've asked me, the question you asked before was about like how do we know it's the inflection point?
Oh yeah, how do we know if it's an
Yes,
inflection
well,
point?
and so look, it's I don't think like there is, for instance, like an answer to this. Like, how do you know it's the inflection point? But it's basically, when you're looking at a business and let's say there's like 10 things you're looking at and seven check out and there's three that don't, but they're on track to checking out. That's kind of what we call inflection point. And it depends what these are. Uh, I mentioned some of them. One product going to multi-product, SMB going to enterprise. Improving whatever, like gross dollar retention because they had some issues, whatever, like specific things. And I think that's what we're calling inflection point. I don't think it's like a true inflection point. It's just more of, hey, these are like hurdles that the company has to resolve for them to become, amazing. They're very good companies. And in my mind, I think they're amazing. But I think in the mind of others, probably they're, not there yet. And then if you can do that consistently, you can do very well. So unfortunately, I can't give you like a specific thing. And that's the difficulty. You just have to, understand and quantify and start becoming used to looking at companies and understanding what you're comfortable with and what you're not. And in terms of like one of our recent investments, I think our most recent investment was in a company called 90, 90.io. It's a basically a very unique company. It's Insight-led DA. They're raising their B. For a B stage company, I think their metrics are public, so I think I can talk about them. The company is basically, like 20 million in ARR, doubling. Very interesting business. So the founder, Mark, unique character. You meet him, you either love him and think this guy is a genius. That's what we thought. But I feel maybe, others were not comfortable working with him. I don't know. But for us, I thought that this guy's just going to build a massive business. It was basically, wow, you're working, like sometimes you meet these like founders that are quite special. And I think Mark is one of those guys. The product itself, fantastic metrics, incredible net dollar retention, very good, like, gross dollar retention, incredible efficiency in terms of growth. Company basically burning very little, and burned very little. Basically, raised an A, didn't really use it, so didn't really raise much to get to where they are. And I think what's unique about them is if you think of this business, I didn't really say what they do, but there's something called business operate. There's something called entrepreneurial operating system. I never knew it existed before we looked at 90. It's basically a way for companies to build, an effective business. So it's like rules and structure as to like how you look at things, how you track things internally, how does your team communicate, etc. And usually there are coaches that coach like companies on how to implement such a system. Mark was a coach. And then he's noticed that there is no actual system or software to help companies basically implement an EOS operating system. And then basically he built it. And he built I think what is an incredible solution for every company that's out there to actually look into and basically try to implement. We have like 20,000 customers. Like I think 10,000 customers. Like I think 15 now. Company doubled since we came in. Doing fantastically well. And this is a type of company. Their sales, they have zero direct sales. They basically coaches refer companies to them. So they work with the EOS organization, where the coaches refer companies to them. They also work with other, similar, BOS kind of companies where the coaches refer companies to them as well. And they build their own PLG motion, leveraging, keywords and stuff, super effective and efficient. So the company is extremely effective and efficient in adding new customers, very good at retaining them. They're like a single product going to multi-product So most of their platform has been like building, so people get a lot of value. And now we started layering like additional products. So we came in at this stage where number one, most of their revenue historically has been coming from like coaches across, these different organizations. They released their basically like, not PLG, but like PLG's always been there, but they released their own 90 OS, which is their own operating basically system. And by the way, if I'm boring you, let me know. I'll stop. But I can talk about companies for like hours. So,
Mhm.
uh,
I
and, and then we came in at the stage where they're like, I would say single product going to multi-product, single channel going to multi-channel, and so each of these is a lever. And I do believe this is going to be a like they're going to keep building and growing and build a massive business here. So yeah, so you can increase ASP. There's very specific ways you can double ASP. You can basically increase TAM. It's exciting to work with companies like that, where you see there's so many possibilities. Everyone's hardworking. Everyone's basically very disciplined and focused. And frankly, I'm learning so much from Mark. Like, he has this amazing, unique approach to a lot of different things. Very, very different than what we've seen in many of our companies in terms of, how you build a sales team. Seriously, like a very unique way of building a sales team without commission. I was like, how is that possible? He's like, yeah, it's doable in specific ways. And so like, he lives also by the values of basically his solution. So again, exciting business. We sourced it through, one of our associates. Actually, I have to give her kudos for that, Amy. Close to Insight, been on top of this company, been tracking it for a while, been excited about it. Was good enough to explain to me, which why is that exciting and interesting, and then basically had already connected with the business and looped me in, and then we knew the Insight folks. So basically that's how it worked. And we there was like several firms bidding on it. I think we moved very quickly. We were comfortable fairly quickly with lots of the unusual things, I would say, or like not typical things. And then we're able to give a term sheet, build a very good relationship with Mark, who I think genuinely liked us, and we liked him. And he said, "Hey, I want to work with you guys. I'm just going to stop the process, and if you guys give me what I'm looking for, we'll just do the deal together." I was like, "Yeah, great," and that's what we did.
I wonder, so in terms of like, I guess, like getting the company's insights. So since like the later stages, a lot of it is to look at, I guess, the deal room to like figure out what's going on. And I wonder what would be the initial screening look like? Would you just go straight into like an Excel sheet, or
Yeah.
would it be like chatting to customers or
Yeah, I think what we do is, even before, so we pre-qualify companies quite early, and we do a lot of work before even getting in front of a business. And the reason for that is we want to be able to move quickly. So a lot of what gets us excited is market, product, obviously growth when we get the numbers, but we'll have a rough estimate or idea just through our network, like what the company is, where is the company, how fast they're growing, etc. But a lot of the work that we do is around gathering reviews. We do actually customer calls before talking to entrepreneurs many times, or CEOs. So whenever we join a call, we know that the team is excited about a company. I'm not going to say it's every time. I mean, there are sometimes you get like intros, sometimes, you just send an email, someone responds, you didn't really get, especially across the team. But as the companies I get involved with, there's been a ton of work that has been done prior, where the team in general is aligned. And basically, we've done customer calls. And the way we do it is, there's like tools out there that will help, facilitate customer calls. And then just, there's like databases where you can already see customer calls. We do like deep competitive intelligence. We look at reviews. We basically spend time on backgrounds. There's a lot of work that goes in before getting excited. So once we get the numbers, it's very quick for us usually. Like, obviously there's decision, like there's questions about like uniqueness of business model, etc. Like how does it work, and like there's like more like operational questions. But we're usually quite comfortable, with, we already like are comfortable with the market, the opportunity, the product, the competition. We have all this knowledge, so it really becomes, yes, more talking about execution, specifically product roadmap, like where are they, what's the plan, and usually we start with that. And last thing we focus on usually is financial. I know maybe it's like it sounds like weird, but yes, I think the last thing, like, we need to be sold on everything before we start looking at financials. At least that's how we view it. Because just looking at financials alone, like, gets you to a point where you're going to still have like a ton of questions around all these initial things. And if you did not address them, it's going to be an issue.
Mm. I wonder, for example, when you're doing customer calls, would it be like you saw it on like Trustpilot and then like trying to cold call the customer to cold call, or like would it be like you already know someone in your ecosystem that may be their potential
Yeah,
client?
it's so it's a combination. So I'll tell you what we do. So we do have, and we're building this now. So we do have lots of relationships with
Mm,
people in tech, like whether it's CTOs, CEO, CROs, VPs of sales, VP of like, sales ops, like head of engineering, head of data, etc. within our network.
mm,
Sometimes the first call is usually to them.
mm,
It's like, hey, have you used this solution? No. Why? Did you look at it? Would you consider, etc.? And start talking to them. And sometimes they give us insights like, hey, I looked at this company, I really like this company, and here's why. And then so, usually it starts there. And then from there, yes, you do look at, reviews online, but we never call these customers. What we do is, so we have our network that we go through.
mhm,
We see customers on their website. So sometimes we just try to like find whoever is like a buyer and try to just email. And then I think what we do, the most effective way is do it is through basically a third party solution. So there's a company called Tigas that we use. I'm sure like a bunch
mhm.
of folks use it. Sometimes they already have calls for specific companies. I mean, like you just go through it and there's already been like, calls about a specific company. Some of them are out, like they'll be like 6 months old, which usually is not that big of an issue. You can look at them, you can look at competitors, you can look at what people are saying, who did they interview. And then we actually contract them, we connect them. It's like, hey, can you connect us to like 3 customers here? Can you connect us to like prior customers? Can you connect it to a customer of like a competitor, etc. And then through our LinkedIn network, when we see customers, etc., we try to through our LinkedIn network connect with like folks. So it is a lot of it is a lot of work, which is why before we start doing this, we need to be like quite excited about like, hey, does this make sense? Is it something exciting, for us? What's unique, etc. And it just happens organically. And then this way, also you gather a lot more information on other solutions as well. It's not like you're just talking about that, but say, what are you using? What's exciting for you? What are you looking at? What are you looking at implementing? So you do gather a lot of insight. And then our team spends a good amount of time doing this, by the way. So yeah. And
How
then in our emails, by the way, when we email folks, a lot of it is insights from there. It's like, hey, here's the insight we gathered. Sometimes we just email a PDF file of like our research or like a presentation to a CEO and say, hey, look, here's all the work we've done. We really like what you're building, and here's why, and would love to talk. And here's kind of, and we love, and usually that works.
um would it like let's say if you are, I guess, how long does a diligence process look like? Let's say if you are evaluating something in a earlier stage, maybe you don't have like the access to Tigas. So
Yeah,
I'm
yeah,
aware of like they're costing like hundreds of dollars even for the people to do like to
that's
be a
true.
research person on there. So like I wonder, first of all, like that's like kind of really costly, and then number two is like I guess like how do you effective, like how long would be the diligence process for this research, and would it be like would you do like a financial modeling to kind of like figure out how much they're actually like the operational cost of a certain company, or like
No,
that's
so
hard?
yeah, yeah. So look, I understand. It's not like we're spending thousands of dollars every week to just get on calls. We do make a judgment call. That's number one. We do try to leverage our network as much as possible and get as much insight as we can. Like we were looking at a company, and basically what we do is we just introduce them to like potential customers and get the customer, which through our network, and get them to give us like feedback on the product. So we do that quite often. So I'm sure others do the same thing. And sometimes we ask
Oh,
our net.
another question. I'm sorry. I like I have a piggyback question for you. So let's say if you introduce them to a customer, let's say that if they're like a Fortune 500, like C level or something, like the CTO of like a Microsoft is their buyer or something imaginary. But this
Yeah,
person, you can't really send them to like a really high level buyer at all time. The buyer would like unfriend me if it's my company. So I wonder, how do you
yeah. You have
navigate
to look.
the?
You have to balance it out. First of all, you can't send 30 different things to someone. But at the same time, if you're looking at a security solution or engineering solution, a lot of the engineering leaders do enjoy learning about different things. You'll say, hey, by the way, we're looking at this. Would you be interested in a quick intro? So yeah, sure, I'd love to. So part of like, they love to. Same, as like I think sales is a little bit different because their whole goal is to sell. So if you're introducing them to something, their first mindset is like, hey, can I sell something to these guys? But it's a little bit different. But yes, you can't bombard people, and you have to know who. Yeah, I'm not gonna email the CTO of Microsoft. I'm not sure if that's like that, or Amex. I'm not sure what you said.
Mhm,
Asking for like reviews on a specific company. So
mhm,
that's not how it
mhm,
works. So yes, and then usually, whenever we want like access to very specific people that we cannot have, let's say, we'll go through like someone like Tigas. Usually, we can through our network. And then to go back to your prior question on like modeling and how do you basically assess, we don't build models internally. I think the only thing we build is return analysis model. Like, hey, what would our returns look like? We don't really build like for like some firms, so they'll build like a base case, minimum case, high case. What does it look like? We do it very high level sometimes, depending, but I don't think that's kind of where we spend most of our time. I think where we spend most of our time is understanding like what are the drivers before, like, can the company quickly articulate and in like a very structured way, why they're going to be able to continue growing.
mhm,
What basically are they focused? Like you can start telling very quickly, like, do they have good sales enablement? No. Can they ramp quickly? Yes or no? How? So you start getting into some of these things sometimes, and depending on what you have to focus on. If companies are doing well and like something, and then there's like issues you find somewhere else, you just drill on these. So in general, yes, at our stage, you do have more data, and but you can get lost in the data as well, so you have to be effective and efficient. A diligence process, if you're going to look linearly at stuff, is going to take forever. You have to be able to move quickly, and you have to be able to understand what to focus on, how to get ask quick answers, basically what data to ask for if there is a need for it, and then be comfortable with it. And then basically be comfortable with it, and this is not also easy. I think it requires experience. And at the same time, it does matter. If the CEO says, hey, by the way, like we lost the deal recently because we couldn't move fast enough. Like we talked to a CEO at the beginning of the week, very exciting company. They basically a little bit earlier for us. Super exciting. I think we'll probably like, hopefully lead their next round, which will be more of a fit. But, we had a week and a half to finalize diligence and get him a term sheet. We just couldn't. I think people were traveling, we got data, we wanted to ask questions, we didn't have that much time, and we were in situations where a CEO says, hey, I just have, you can have one call and one meeting. I was like, dude, like, okay, fair. It's not enough sometimes for us. And we had like a bunch of like actually very, like, and they still got like 6 term sheets. And he chose one, but based on a call. Like,
mhm,
that's fine if people are comfortable with that, like one call, and they know the industry inside out, and they have 0 questions, and they only are okay with the data that the folks present, then that's fine. So sometimes it's like that, and you just can't move quickly enough. But sometimes you can, and it really depends on the deal itself. Earlier stage is much more difficult because, I mean, not more difficult, but there's a lot more uncertainty. And it's really longing the team and the product, and you just start like it's looking at different metrics than what we're looking at. It's traction, it's marketing, depending on what type of companies you're looking at. It's like different metrics, and different focus. It's kind of like playing poker.
mhm,
By the time we come in, it's kind of the flop or river. When
mhm,
you're early stage, it's like pre-flop. So
Mm.
or like maybe you just seen some. So it's just there's more uncertainty, more unknowns, and you just have to like I assume like know what you're looking for and what basically are the patterns and the metrics that you want to see.
Amazing. Okay, so I want to be mindful of the time. We have another live coming up, but I want to like end with like a quick 30-second fire round for you. Okay, so what's your favorite book?
Favorite book is uh, okay. So favorite book about basically like favorite book that I really read that I enjoyed a lot is um, I think the biography of um, who is I think the biography of Bob Iger, you know,
Mm,
was
mm,
one of the recent books that I read that I really liked. Just talking about Disney and basically seeing how cool he was. Just made it so easy, like sound so easy to build, like how he evolved in his career. I
mm,
usually like to read biographies. I've read a bunch of them, and it just feels to me like I can learn a lot from those. Um, Recently, I read Ready Player One also,
mm,
which is I usually read two books at a time. One that's like more focused, one that's a little bit more like fictional. So yeah,
mm. Amazing. Okay, so who made the biggest impact in your career?
I think my partner, is definitely Mir. Made the biggest impact. He gave me a chance to partner up with him, and basically build Blue Cloud. And along the way, I think every stage of my growth, I've met some amazing people that have helped me a lot. Um, you know, um, so being an investor, there are some other VCs that took interest in mentoring me, which I felt was awesome just because they wanted to. Earlier, before that, I had like folks that mentored me when I left or started university. So I think every stage of your life, you get people. I think there's a friend of mine now that has helped me a lot mature emotionally. That I think is an amazing person. So I think like many people actually have a lot of effect on you, and I think every stage of your life there's someone else. But yeah,
Mm. Who would you invite to your dinner party?
who would I invite to my dinner party if I had the chance? Uh, dead or alive.
It's your party.
Yeah, it's gonna be a little bit weird, but Bruce Lee for sure. I'm a huge martial art fan. I think he's been an idol for me like throughout my life. uh, how many people do I get?
It's your party.
Okay, so probably Bruce Lee would probably love to, spend time with Bill Gates, if
Mm,
possible. Uh, would love to, I think, from a basically m- movie star perspective, um, I'd love to have, and I think Leonardo DiCaprio is probably one of my best favorite actors. I think he's like all his movie have been amazing. Um, yeah, just
amazing.
sports, like work and political. Frankly, I'm not really gonna get into it, but yeah.
Okay. Amazing. Well, Remy, thank you so much for coming on the show today. It's always so fun to chat with you.
Thank you, thank you.
Okay, let me quickly end